Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host, and today we're exploring an expert advisor called Volume Zone Oscillator. This strategy is built around a single, distinctive indicator, the Volume Zone Oscillator, and it uses volume itself to judge when a trend is genuinely being backed by participation rather than by price alone. Over the next few minutes, you'll learn exactly how it reads the tape, how it enters and exits, and how its risk framework is structured. Remember, this is educational content only, so let's dive in. Let's start with the big picture. Volume Zone Oscillator is a trend-following expert advisor for MetaTrader 5, and its engine is the Volume Zone Oscillator, sometimes shortened to VZO. This indicator was described by Khalil and Steckler back in 2011, and what makes it interesting is that it measures volume with a direction attached to it. Every bar is tagged as an up bar or a down bar, and the oscillator compares smooth sign volume against smooth total volume. When buyers are doing most of the work, the reading climbs into positive territory. When sellers are in control, it sinks below zero. The idea behind this strategy is to ride trends that are confirmed by participation, not just by a rising or falling price line. Price can drift higher on thin, unconvincing volume, and this approach tries to filter those moves out. It pairs the oscillator with a slower moving average baseline that defines the overall regime. Only when price is on the correct side of that baseline, and the baseline is sloping the same way, does the strategy consider an entry. It runs on any liquid symbol and on whatever single time frame you select when you test it. Because it uses tick volume as its volume proxy, it works on the foreign exchange market, where true traded volume isn't published. In terms of who it might suit, this is an educational example aimed at traders who are curious about combining volume analysis with classic trend filters and who want to study how such rules can be written into code. It is a systematic, rules-based approach, so every decision is defined in advance rather than left to discretion. As always, keep in mind that trading carries real risk. Losing trades are a normal part of any strategy, and nothing here is a recommendation or a promise of any particular outcome. Now let's walk through the mechanics step by step. The expert advisor only acts once per bar when a new bar opens and the previous one has closed. That keeps its decisions clean and avoids reacting to every flickering tick. First, it builds its context. It calculates the volume zone oscillator over the VzoPeriod, which defaults to 14. It measures a trend baseline using an exponential moving average over the trend period, which defaults to 60 bars, and it checks the slope of that baseline over the last 3 bars. It also reads the average true range over 14 bars to size its risk. For a long setup, 3 things must line up. Price must be trading above the moving average baseline. That baseline must be sloping upward. And the oscillator must cross up through the positive signal level, which defaults to 15, having been at or below it on the prior bar. That crossing is the key event. It means fresh buying volume has just taken the upper hand. There's one more guard. The oscillator must still be below the overbought level, which defaults to 60. If volume is already stretched far into positive territory, the strategy stands aside rather than chasing a move that may be near exhaustion. The short setup is the exact mirror. Price must be below the baseline. The baseline must be sloping down, and the oscillator must cross down through the negative signal level while remaining above the negative overbought level. Once a position is open, risk is framed immediately. The stop loss is placed at a distance of 2 times the average true range from the entry, using the stop multiplier. The take profit is placed at 3 times the average true range, using the target multiplier. That gives a reward to risk shape of roughly 3 to 2 on every trade, defined by volatility rather than by a fixed number of pips. There is also a second exit. If the oscillator flips all the way to the opposite signal band while the trade is live, the volume thesis has broken down, and the expert advisor closes the position early rather than waiting for the stop. Finally, the strategy holds only one position at a time per magic number, so it never stacks new entries on top of an existing trade. Every one of these steps is fixed in the code, which we'll look at next. Let's read the actual meta-editor code that the expert advisor runs. At the top are the inputs, and these map one-to-one with the parameters you can adjust in the tester. VzoPeriod sets the smoothing length of the volume oscillator. Trend period is the length of the moving average baseline that acts as the regime filter. Signal level is the band the oscillator must cross, and overbought level is the point past which the strategy refuses to chase. Then we have the ATR period and the stop and target multipliers that shape risk, along with the order volume and the magic number. Below that are two Boolean checks. Up is true when the last close is above the baseline and the slope is positive. Down is the opposite. Look at the long block. The condition asks that up is true, that the oscillator was at or below the signal level on the previous bar, that it is now above the signal level, and that it is still below the overbought level. When all of that holds, the code reads the ask price, sets the stop loss at the entry minus the stop multiplier times ATR, sets the take profit at the entry plus the target multiplier times ATR, and calls trade.buy with those levels. The short block is the mirror image. It requires down to be true, the oscillator crossing below the negative signal level while staying above the negative overbought level, and it calls trade.sell, placing the stop above entry and the target below. Notice both sides normalize their prices to the symbol's digits before sending. It's clean, symmetrical, and completely rules-based. Let's bring this to life on the chart. Below the candles, you can see the volume zone oscillator plotted in its own panel, with the signal bands marked at plus 15 and minus 15, and the stretch zones marked at plus 60 and minus 60. The smooth line running through the candles is the moving average trend baseline. Watch the opening candles on the left. Price is drifting gently lower in a quiet consolidation, and the oscillator is sitting below zero, dipping toward the lower signal band. That tells us sellers have a mild edge, but there's no trend the strategy wants to join yet, because price is still hugging the baseline and the oscillator hasn't done anything decisive. Now look at the fourth candle. Price pushes up and closes back above the baseline, and crucially, the moving average line itself has just turned upward. At the same moment, in the panel below, the oscillator climbs and crosses up through the positive signal band at plus 15, coming from below it. That is the exact event the strategy waits for. Fresh buying volume has taken control inside a rising regime, and because the reading is still well below the stretched level of 60, the move isn't overextended. This is where the buy entry marker appears. The instant that long is opened, the risk frame is set. The stop sits below the recent swing low, a distance of 2 times the average true range beneath the entry, and the take profit sits 3 times the average true range above it. From here, we simply follow the trade. The next several candles print higher highs and higher closes. The baseline slopes up beneath them, and the oscillator holds firmly in positive territory, confirming that volume is still backing the advance. Price reaches up to the take profit target, and the long is closed at its objective. Notice how the reward side, at 3 units, is larger than the risk side, at 2 units, giving that 3-to-2 shape we discussed. Then the character of the market changes. Around the peak, the last up candle stalls and a bearish candle takes over. Price rolls back down through the baseline, and the moving average line begins to flatten and turn lower. In the panel, the oscillator, which had been strongly positive, falls sharply back toward zero as the buying volume dries up. Watch the candle where price is now clearly below the baseline, and the baseline is sloping down. And that brings us to the end of our breakdown of Volume Zone TrendPeriod. We covered how the Volume Zone Oscillator measures directional volume, how the moving average baseline defines the trend regime, how a signal band cross generates both long and short entries while an overbought guard keeps it from chasing, and how the average true range frames every stop and target. We also read the actual meta-editor code and watched the logic play out on a chart. Remember, everything in this video is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. If you found this useful, please like the video, leave a comment with strategies you'd like us to examine next, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.